alternative investments is what I want to talk about for this segment. And I think to help define that, I'll first go into what is a traditional investment. Well, that's what you probably know from what you're invested on already. That's stock mutual funds, big individual blue chip stocks, bonds, bond mutual funds. They're kind of the building blocks of the portfolio. These things are priced every day, they're liquid, they can be bought and sold, they're regulated, there's safeguards as much as possible against fraud, all that stuff. And that's why they're going to continue to be the lion's share of my own portfolio and my client's portfolio. But I want to talk about the future because we can't just assume that the next 10 years are going to be the same as the last 10 years. The long-term average of bonds is about 4.5%. But there's no way I'm going to use that number for the future 10 years. Interest rates are at all-time lows. The 10-year Treasury bond is paying 1.5%. Meanwhile, stocks are at all-time highs, and that's great. And I still believe in stocks for the long run, and I'm not predicting any sort of doom and gloom. Stocks have averaged 9% a year over the last 80 years or so. However, based on where they are now, where valuation ranges are, other things that I look at, I wouldn't be shocked if returns are a little bit under 9% for the next 10 years. So both of the two main investment categories, in my opinion, are poised for lower than average rates of return over the next 10 years. So as your advisor, as a fiduciary, I'm looking elsewhere. Now let me go into things that I would consider alternative investments. You've probably heard of hedge funds before. They can sell stocks short and benefit when stocks go down. They can use borrowed money and leverage their funds. They can employ timing techniques. So I'm not a huge fan of hedge funds and private equity for those reasons. However, I tell you what I have been using, or at least an example of what I have been using. I use a fund from, actually it's from JP Morgan, one of the leading financial institutions. And they have a fund called their Hedged Equity Fund, and it employs, first of all, it's liquid, and there's no lockup periods, the fees are reasonable. There's no minimum net worth requirements. And I really like the risk return profile of it because what it does is on a quarterly basis, and it resets every quarter, it protects the investor from market drops between 5 and 20%. So if I invest my own money in this fund, I put $100,000 into it, and the S&P 500 drops 19% during the quarter, I only lose 5. I'm not protected on the first 5, I'm on the hook for that. But from 5 to 20, I'm totally hedged or protected against. If it drops, say, 23%, I lose the 5 and I lose the additional 3, so I'm only down 8. And so I'm only down 92,000 in a horrible, almost crash-like scenario. I'm at 93,000, and the person that invested in the S&P 500 fund is at 77,000. So that's really good protection, especially for retirees, more conservative investors. Now, in exchange for that, there's a cap on what you can make on the upside. And that is roughly 4% per quarter. So if the S&P 500 is doing really well and makes 7% for the quarter, and I have 100,000 in there, I make 4% because I'm capped and it goes to 104,000. If it happened to do that every quarter for the year, I have a 16% upside, which is pretty good upside for the amount of downside protection I'm getting. Because really, we want to protect against, a down 3 or 4%, that's a mild disappointment. For retirees especially, we want to protect against those big drops. And I think this fund does a really good job of that while still giving you a heck of a lot more upside than a treasury bond paying 1.5%. For my typical retiree, I still have those bonds in there because they rarely ever lose. I still have my stocks because I do think stocks will produce better returns than this fund over the long haul, but they're going to be more volatile. And then this and 2 or 3 other funds like it, I have as kind of my middle piece based on the environment we're in now. Younger investors that have 10 years or more and can weather those stock market storms are still probably going to be better off in stocks, but this fund is a really good in-between investment. And it's a really good example of what I would call appropriate use of alternative investments.